So welcome to today's presentation. My name is Peter Youssef, Senior Market Analyst at IronFX. We're going to be mixing technicals with fundamentals as always. In front of your screens you have your USD. We're using daily charts. And daily charts are to be used practically throughout the presentation unless otherwise stated. There may be cases where we will have to drill in to get more detail or drill out to get more the wider picture of the trading instrument. We're going to be passing through FX market pairs and possibly having also a look at US stock markets, gold and WTI today. Should you have any other instrument you would like to have a look at, feel free to add it on the comment section. If we have time today, why not? If not, we can have a look at it tomorrow. Starting with Euro USD. What we saw yesterday was practically a strengthening of the US dollar, in my opinion, across the board. And there are two factors which tend to provide support for the USD right now. For the time being, the first would be the Fed's intentions. Fed policymakers over the past 1.5 weeks have practically allowed for some doubts regarding its intentions and its rate cutting path. It's characteristic that more and more Fed policymakers are highlighting the possibility of one, maybe two rate cuts until the end of the year. And that tends to come into contrast to the market's expectations about two rate cuts until the Christmas period. May I also remind you that the next Fed's interest rate decision is on the 6th of November, that's in 2 weeks' time. And should we see Fed policymakers further casting doubts on whether there will be two rate cuts or not until the end of the year, then we may see the USD gaining additional support. I'm highlighting here this also because today we have no major financial data being released from the US, so we expect fundamentals to lead the way for the US dollar. And there are a number of Fed policymakers which are scheduled to speak today. The second issue I would be highlighting would be the Fed's intentions. Sorry, the US elections. There seems to be an increased market sentiment that Trump may be winning the race. I know that polls tend to show that it's going to be a tight race, and whatever the result, it seems that it will be within the statistical error. There are some very slight hints from qualitative measures which tend to imply a small advantage for Trump, and he seems to be building up this advantage, especially in swing states which are heavily contested. And that allowed practically for for market expectations to be enhanced that Trump will be winning the elections. And it's characteristic that we're talking about the Trump trade. And in a nutshell, okay, let's explain this a little bit. Now, should Donald Trump be elected, we may see the US practically having a policy economic policy which will be more isolationism. So practically it's characteristic that that former President Trump has mentioned definitely more than once the word of tariffs and the positive effects they may have in the US economy. That's his opinion. It's not exactly orthodox economic theory here, but his intentions seem to be to slap tariffs around the world. slab tariffs on the Eurozone, slab tariffs on Mexico, slab tariffs on China, more. So these intentions could provide, at least in the short term, support for the US dollar and weigh on emerging markets. So that's one. For US stock markets, there are increased hopes of the market for a possible more extensive deregulation, maybe even some further lowering of the corporate REIT tax, which could provide support for US stock markets. I would be noting also that cryptos, despite Bitcoin's correction lower yesterday, may get some support as Trump is considered to be more crypto friendly than Harris. Last but not least, and we see that later on with gold's price as well, the precious metal seems to be gaining safe haven inflows from the uncertainty of the overall situation, which has caused it to reach new record highs and it's still rising. At this point, I would be noting overall that once again, uncertainty is high, the stakes are high, and that causes the market to be very, very jumpy. There is one thing about the US elections which tends to pass a little bit unnoticed or under the radar if you prefer. On the one hand, the market is focusing, understandably is focusing, on the presidential elections. But it's not the only elections in the US happening at the same time. We are going to be having also elections about seats in the US Congress. And that enhances how complicated the future overall picture is to be. For example, we may see on the one hand having a red sweep where practically Trump is elected president, and at the same time the Republicans have control over the Congress, and that would be causing one kind of a market reaction. There could also be the possibility that Trump wins the presidential elections, yet Congress remains with the Democrats. That could cause a different market reaction. You may have the result where Kamala Harris wins the presidential elections, but Congress remains with Republicans. And finally, the fourth scenario would be that you have Kamala Harris winning the presidential election and the Democrats keeping control over the Congress. That would be a blue sweep. And that would be a totally different scenario, which could cause a understandably different market reaction. So US elections may be more complicated than initially anticipated. And to that end, I would be also adding another scenario. It's a little bit extreme in the following sense. What could happen if, on the one hand, Kamala Harris wins the elections by a very tight margin and Trump practically does not respect the result and contests the result? And that could create a relative chaos in the markets. So be on the watch out for this. It's going to be a big issue as the election date is nearing. We seem to be getting a clearer picture, but uncertainty remains high. On technical level, Euro USD, despite a slight correction during today's Asian and early European session, seems to maintain a bearish momentum, and that's indicated by two factors very clearly. The first would be that we have a downward trend line leading the pair lower, and that's been ongoing since, let's have a look, the 8th of October. So as long as the downward trend line remains intact, we maintain our bearish outlook. Also note the RSI indicator, which has risen slightly, has corrected a bit higher. It's now at 32.4, which is very low despite the correction higher, and tends to imply more or less a quite strong bearish sentiment of market participants for the pair. So should the bears maintain control over Euro USD, I would expect it to drop below the S1 1.0825 something, which happened during today's Asian session. However, the pair was able to correct higher. And the S1 to be broken, hence the next possible target for the bears would be the S2 1.0775, which was providing support here. It was the clearest indication of a support level being existing here. On the flip side, should the bulls take over, we may see the pair rising, breaching the prementioned downward trend line. That would be a first signal that the downward motion was interrupted. And it would be also a signal to change direction of trades. In such a case, should the downward trend line be broken, we may see the pair remaining in the spectrum between the R1 and the S1 in a sideways motion. And should the bulls clearly take over, then we may see the pair rising, breaking the prementioned downward trend line. But also I would require a breach of the R1 1.0885 and the pair to start aiming for the R2 1.0950. Now on the euro side of the pair, things are still pretty grim. Today I will be noting that ECB President Lagarde will be speaking. There are a number of policymakers of the ECB which are scheduled to speak today, among them also ECB's chief economist Lane. And I wouldn't be surprised to see more dovish talk coming out of ECB policymakers, given that the economic situation of the Eurozone, I wouldn't say the situation, the outlook about growth seems a bit bleak. And that's an issue. And it's practically pushing the ECB to ease on its financial conditions further. It's characteristic that by the end of next year, 2025, the market expects ECB to lower rates to the 2%, and we're talking about the deposit rate here, if I'm correct. So it's a big jump, or the expectations, the dovish expectations of the market for the ECB are extensive. And overall, should the bank actually allow for those expectations to be enhanced, we may see the euro weakening on a monetary policy level. Okay, let's have a look at USD and JPY. We'll see a reverse picture here. Now, first of all, allow me to clear the chart. And definitely, we're going to be deleting the trend lines. And the rectangles. Okay. Now we have a clear chart, and I'm going to be doing technical analysis from scratch here. Let's start with direction. Definitely there's an upward direction that's clear. So the bullish movement, in my opinion, is obvious. We had a start around the midst of September, actually on the 16th. It's characteristic how the pair hit a low point right here and started to rise. A correction lower practically set us or showed us the second point for the upward trend line. Yet the upward trend line since the 30th of the month intensified substantially up until the 4th, 5th of August, where another correction took place. And since then, I may say that the upward movement is being maintained, but it has slowed down. And it continues today. Yesterday it was very obvious, and today. And do not be fooled, this is not only a USD strength, it's also a JPY weakness. Practically, how the pair was able to jump and continue to rise yesterday was something which was beyond the strengthening of the US dollar against other currencies. It was stronger against the JPY. And it's understandable because on a fundamental level, there is some uncertainty about Japan as well, because we have the elections on Sunday. And at some point, there was a big question mark who will be winning. And it was a bit of an issue in the sense that the government also tends to not intervene, but may have a bearing on BOJ's stance as well. And I think that may have been the main issue which weakened JPY yesterday. So on a technical level, the upward direction, despite the easing of the slope, the upward slope is still present. So we maintain our bullish outlook. The RSI indicator is just below the reading of 70, which tends to imply also a strong bullish sentiment for the market. And I would be noting also the fact that the price action has still some distance between itself and the upper Bollinger Band, which allows for some room for the bulls to play here. Once again, bullish outlook inside remains. The question is how high it could go. And you can see how there was a resistance line keeping the sideways motion of USD JPY at bay. That was at the late days of March, early to mid April. So one resistance level would be here, in my opinion. And that would be the 152. It's actually 151.98. Okay, 2 pips are not an issue. And it should be set in red as we're looking for resistance lines. That's one. I would be noting another resistance line on this level here. And you can see how this also worked as a support line and resistance line. So that's pretty valid as well. The third level, I would be placing it a little bit further away. This peak is very characteristic, and you can see it also providing resistance here and some commotion here. And the final resistance line would be at the top. This is where practically all this upward motion ended, stabilized for a couple of days, and then went all the way down. In my opinion, that's maybe the most clear resistance line in the chart. And 162. Yep. It didn't go exactly at 162, but it was at 161.98 or something. And now let's place some labels. The R3 being set at 158.35. Locking it in. The R2 being set at 154.80. And the R1 at 152. Okay, so should the bullish outlook be maintained, the next possible target for the bulls is being set at 152. Should that be broken, then the next possible target for the bulls at 154.8. That's 280 pips higher. It's extensive, but we are in the daily chart. So given that we have an outlook for about a week or so, it's a target which could be easily reached. Let's have a look for support lines. What should happen if the bears take over? Now for bearish outlook, should the pair start dropping, the first possible stop for the bears, once again, sideways motion here, and it found support, could go a little bit lower, would be also in conjunction with the support line which was found hit yesterday at 149.10 in green. Second support line, I'm going to go a little bit wide. That's one level where we have a nice throw, and also the pair found some support here. So that's the 146.45. Another support line, I'm placing it here on this throw. I'm neglecting this false break here, but this was very characteristic how the pair was dropping, bounced on this level and rose back up. That would be the 143.45. And finally, the ultimate support line being set at the lowest throw available on the chart in this case, and that would be the 139.65. Let's place some labels. S1 being set at 149.10, the S2 at 146.45. And final support line, or the S3 being set at 143.45. So once again, where bullish outlook remains for a bearish outlook, okay, that could be a little bit remote right now, but for a bearish outlook, I would require the pair to drop, break initially the pre-mentioned upward trend line, signaling exactly the interruption of the upward movement, but I would also require the pair to drop below the 149.10, with the next possible target for the bears being set at the S2, the 146.45. Okay. I would like to have a look also at another FX pair, and that would be the pound. Here you go. I'm highlighting the pound practically for two reasons. It's not technical, it's fundamental. There is a trend which may pass unnoticed, not a trend, a trade, which may pass unnoticed today, and that is revolving around BOE Governor Bailey's speech today. The BOE governor will be speaking is to make statements, and given the easing of inflationary pressures for last month, that was released, if I'm correct, on Thursday last week. I would expect the BOE governor to start preparing the markets for a more aggressive rate cutting path. Hence, we may see the comments of BOE Governor Bailey being more dovish. And in that case, we may see the comments weighing on the pound. It's a very interesting element on a fundamental level, I know it. And on a technical level, the downward trend line remains intact. Allow me to draw it. It's here. You can see we have one peak, a second, a third, a fourth. If we drill into the 1 hour chart for more detail, it will become more obvious. Okay, 4 hour chart to see the start. Here it is. See how the pair is dropping once, continuing a very slight, subtle bearish movement, correcting higher, hitting on the trend line, second hit. Dropping, correcting higher, hitting on the trend line, third hit. The only element which tends to cause me to doubt a bit is the fact that the trues here at the same level. This is the 1 hour chart as well, the 4 hour chart as we have mentioned. So there is some hesitancy on behalf of the bears to actually surpass this level to the downside. Back to the daily chart. Should that be broken, then practically we may see the pair start aiming for the 1.2890. Allow me to correct the chart yet, the resistance and the support lines on the chart. Definitely the 1.3030 has to be turned into resistance line given that the price action is below it. Let's have a look beyond the 1.2675. This is a possible level, yet in my opinion that's too close to the price action. On the other hand, I would be noting this true here. Sorry. Let's go further back. There's some resistance support here as well. It could go a little bit higher in my opinion. We have a recurring support line here. You have tests, multiple tests here, here, and some commotion here. I'm going to prefer this level. And then we have, let's color this in red, in green, 1.2515, and setting the final support line here. Seems good. Readjusting the chart. Let's reposition the labels and correct the content, starting with the R3 at 1.3435, the R2 at 1.3260, the R1 at 1.3030, the S3 at 1.2515, the S2 at 1.2675, and the S1 at 1.2890. Now, should we see the bears maintaining control over the pair, I would expect the next possible target for the bears being the 1.2890, which used to be a former resistance line. It was characteristic how the level provided resistance back here. But given that the price action has moved above it clearly over the past 2 months, we tend to view it now as a support line. So should the bears maintain control, I would expect the price action to start aiming for the S1 1.2890. On the flip side, a possible stabilization over the coming week of the pair would practically be breaking the mentioned downward trend line, while for a bullish outlook, I would require the pair to rise, breach the mentioned downward trend line, but also most importantly, breach the R1 1.3030 and start aiming for the R2 1.3260. The RSI indicator is between the readings of 50 and 30, implying a bearish predisposition of the market, which is understandable. There is quite some room between the price action of cable and the low Bollinger Band, which may exactly allow the downward motion to be maintained. Let's have a look at US stock markets. And before that, let's have a look at gold. Gold is a very interesting chart because it has reached new record highs. Here you go. Let's correct the upward trend line. And it's interesting how the pair is now testing the 2730. I'm setting the next resistance line at 2830. We're going to be releasing a full week ahead gold report today, so feel free to have a look at, even share. Okay, let's play some labels. Starting with the R3 at 2780. No, that's incorrect. It has been broken. So it's being set at 2830. The R2 at 2780. The R1, which is being tested right now, it's the 2730. The S1 at 2685. The S2 at 2635. And the S3 at 2550. Sorry, 2600. So for the time being, the bullish outlook for gold's price remains. One small word of warning here. Note how the RSI indicator has breached above the reading of 70. That tends to imply that on the one hand, there's still a strong bullish sentiment of the market for the precious metal. Okay. But at the same time, it may also be implying that gold's price has reached overbought levels, and the precious metals price may be ripe for correction lower. So it's a big issue. Why? Because we're getting the same signals from the fact that the price action is testing, constantly flirting with the upper Bollinger Band. That puts pressure on the bulls to abandon their efforts. On the other hand, we have a clear upward trend line, and if we drill into the forward chart, it becomes even more clear. Sorry. Let's lower it a little bit to the right. 1 hour chart. Yeah. So the upward trend line, as long as it remains, we tend to maintain a bullish outlook. But note once again how the price action is having problems to actually surpass these peaks are practically at the same level. We need a higher peak. And that's what's causing me to doubt a little bit. Overall, though, the bullish outlook remains intact, and the upward trend line has to be broken in order to switch it. On the fundamentals of gold market, Okay, definitely the negative correlation which was conceived by the market about the two trading instruments, and we're talking about gold and the USD. Whenever we saw the US dollar strengthening, we saw gold's price falling, and vice versa. When the US dollar was falling, gold was rising. That's not in play. Also, the negative correlation of gold's price with US bond yields seems out of touch right now. US yields are rising, and at the same time, we see gold rising as well. I think that uncertainty of the market is providing safe haven inflows for the precious metal, regardless of any other market movements. While I may also add here that the fundamentals surrounding gold's price tend to be more global rather than the USD, which is focusing mostly on the US. That should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.
Okay, let's go ahead and get started. So, for those of you guys who've just joined, today we are talking about the advanced harmonic strategy. As per usual, before we get started, a disclaimer and risk warning. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, so you should ensure that you understand the risk involved. Disclaimer: the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is strictly prohibited. So I'm Melanie, and I'll be your speaker for today. I'm an investment analyst from Rocket, who are finalist for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. We're going to do a brief recap on Fibonacci in case any of you guys weren't around for those webinars. And then we'll look at market structure, followed by an intro to harmonics, and then we'll look at the different types of patterns. So feel free to let me know in the chat if you guys have any questions throughout the webinar. And yeah, let's go ahead and get started. So firstly, let's start off with the different Fibonacci retracement levels. So these are the Fib numbers that we normally use. So you can take a screenshot here if you want. But now that we know how to draw the Fibonacci retracement trend line, which you can see in the GIF here, basically drawing from the top to the bottom, ensuring that you follow the shape of the market structure pretty closely. Okay, so then we can look at the different types of levels. So we have the levels that are ranging from minus So minus 61 all the way to more than 100%. Why do I feel like my video is kind of lagging? Okay, yeah. Um, where was I? Yeah, so these are the different levels that we use, and they each have a different technique for the range. So for the negative levels, so minus 61.8 as well as the minus 27.2, we look at using Fibonacci expansions. So an expansion, I'll show you guys how we can use it in a bit. Next, we have the mid-range Fibonacci retracement levels, and those are from the 23.6 to 78.6. And then lastly, we have the levels that are greater than 100%, which would be our extension levels, and those are the 127 and the 161.8. Okay, so you can see the main three levels that I talked about in our previous slide are the retracements, expansions, and extensions. And you can see exactly how they are used in our GIFs here. Don't worry too much about this projections GIF, because we're not going to be focusing on that for now. So for retracements, it's exactly the same. You're just following from the top to the bottom. For expansions, which are the levels that are less than 100%, less than 0%, so the negative levels, you're mainly looking at finding this lightning bolt kind of shape or like a flash symbol. And then you're taking the starting point and ending point, and you are kind of projecting where prices are headed towards once price has fully surpassed that level here. Okay, so it has to surpass or retrace at least 50% of your initial trend line before you can use this expansions technique. Okay, and then we're projecting where prices will head towards the minus 27 or the minus 61. Okay, as for extensions, we are looking for reactions off of the levels that are greater than 100%, so 127 and 161. And for extensions, we are looking for this Nike tick kind of shape. So you can see our starting point, ending point here for our trend line. Once price has fully surpassed that 100% starting point, then you can go in and use this technique. Okay, so we're basically watching for reactions off of the 127 and 161 for this technique here. Why do I feel like my video is frozen again? Can you guys hear me? Okay, I think the audio is fine. It's just the video. Um, so I'll just switch the video off for now. Oh, is the video okay as well? Okay, now it's okay. Okay, let's just move on. So if it freezes again, I'll just switch the camera off. Okay, video is stopping. Yeah, I'll just switch it off then. The next time that it freezes. So anyway, these are the different Fibonacci retracement levels if we're looking at it all at one glance. So you have the positive Fibonacci retracement levels that are greater than 100%. Over here, those are your extensions. Your mid-range would be between the 0 and 100. And your negative Fibonacci retracements, which are also your expansions, those would just be the minus 27.2 and minus 61.8. So the reason why we are going through Fibonacci first is because harmonics plays a lot into the theory behind Fibonacci levels. Okay, so we'll just do a brief recap on it in case there are some of you guys who haven't been with us for that long. We do have a 4-part series on Fibonacci if you guys were interested on that. Yeah, so we go through in depth in each webinar the different types of Fibonacci's. But for this webinar, I'll just do a really quick run through of each of the techniques. Okay, so let's move on. We're now going to look at a couple of examples. So here you can see I've drawn a retracement level from this 0 to 100. My prices have rebounded off the 61.8 level. Here you can see prices are rebounding off this overlap level. So what an overlap level is basically when there are swing highs and swing lows that respect that area. We call it an overlap because the bulls and bears of your price are respecting that area. Okay, so here we can see our 38.2 prices reacting off of it. And that's also in line with that overlap level. So when you combine your horizontal levels, like your pullback, your overlap levels, with your Fibonacci levels, then it really strengthens your analysis and the chances that prices are going to rebound off those levels. Okay, so for harmonics, normally it plays off of the 61.8, which is also called your golden ratio for harmonics strategies. So the main levels that harmonics uses are the 61, 78, and also the 127 and 161.8 that we went through earlier. So the 38, okay, just give me a second. Okay, sorry about that. Yeah, so if you're just using Fibonacci without the harmonics, we look at all of the levels. Yeah, but I just wanted to highlight, since we are talking about harmonics, 61, 78, and the levels that are greater than 100, which we'll touch on in a couple of slides. So in this slide, we are focusing on the 61.8 level. First retracement we have is this bigger one here. And you can see the 61.8 lining up with the swing high here. The second Fibonacci retracement we have is from this swing low to the swing high. Prices bouncing off of this swing low support level are also in line with a 61.8 retracement. Okay, so this shows you 61 is a pretty common level that's used to determine potential reversal points within harmonic patterns. Okay, here we are briefly touching on Fibonacci expansions. So for expansions, I talked about the flash kind of shape or like a lightning bolt symbol. So you can see the yellow arrows kind of form that shape. So your expansion level basically traces out the start or the head of your shape. Okay, so this works especially well because you have the mid-range Fibonacci levels. Here you can see a 61.8. And you're also using the negative levels, so the minus 27.2 is where we are projecting price to come down and bounce off of. So your 61.8 is your typical retracement level that we've seen in the previous examples. And your minus 27.2 is basically where we are expecting prices to reverse off of. So you can see that's exactly what happened here. Price bounces off really nicely from the minus 27.2 expansion level. Okay, a pro tip is that price usually comes back to the ending point. ending point is basically the first swing low of your shape. Okay. Okay, so now let's look at extension levels, which are your Nike tick levels. The yellow arrows draw out really nicely the shape. You're basically taking the head of your tick and projecting prices where prices will reverse off of. So this Fibonacci extension is also commonly used in harmonics as well. So namely the 127 and the 161.8, like we see here, prices are reversing off of it. And yeah, so you see that huge reversal off of this level here. Okay. Okay, so here's a GIF that shows you how to identify the shape and also how to draw your trend line and what you can expect to see from this 127 and 161 levels. Okay, so for Fibonacci projection, I'm not going to dwell too much on this. I'm just going to briefly mention it a bit. But basically for your Fibonacci projection, we are using that same flash shape that we saw for your expansion levels, so the levels that are less than 100%. For extensions, projections, we are using the Fibonacci extension tool. So it's a bit confusing, but it's a completely different tool compared to the tool that we've been talking about for the past 3 strategies. So for this method, we're using the Fibonacci extension tool on TradingView, and that basically uses 3 points. Okay, so you can see in the GIF, we have a starting point, middle point, and ending point. And the levels that we're looking at are 61, 78, and 100. 161 if you're looking at using an Elliott wave. So ultimately, unlike the other 3 points, 3 methods that we went through, this uses 3 points. So 1, 2, and 3. And you are following exactly that lightning bolt kind of shape and projecting where prices are going to reverse off of. Okay, if we look at another example of this, you can see really clearly the starting, middle, and ending points follow the swing highs and lows of price. And price has bounced off of that 100% very nicely over here. So here's an example with a very obvious zigzag or lightning bolt shape. Here, you want to take note of the Fibonacci trend line that follows the market structure really closely to project the price to reach your 78.6% Fibonacci projection level. Okay, so let's see how this plays out. So you can see price has reversed off the 78.6% Fibonacci projection according to our previous analysis. Last example, take note of that zigzag shape again, or flash shape. This time it's kind of inverted, so instead of being upright like this, it's upside down. Notice that there is a very clear movement in price structure, which our Fibonacci projection trend line follows. The starting, middle, and ending. And then your last part, or the tail end of your lightning bolt shape, follows your projection. So you're projecting where prices will bounce off of. So here you can see we're projecting prices to bounce off the 100%, and that's exactly what happened here. Okay, so for invalid Fibonacci retracements, one of the most common scenarios of this is when price makes a lower low. So that's assuming if you are drawing a Fibonacci retracement from the top to the bottom. So if there are bars on the right that break your ending point, it then becomes invalid. So there are Fibonacci retracements that are in negative that we saw earlier, but basically they go beyond your endpoint and they are still valid. So for example, here we have prices breaking below your ending point. So this then becomes an invalid retracement. So you always want to remember to pick the lowest point with nothing on the right of that ending point. Okay, now let's talk about market structure. So this is pretty important regardless of whatever strategy you are using, but particularly for harmonics because you're basically using price action. So these swing highs and lows are too insignificant, so they're bad points to use for your Fibonacci points, but they're also bad points to use for your support and resistance levels as well. Okay, so when you're choosing a chart, you can flip between the different time frames to choose a chart that gives you a really clear market structure with significant swing highs and swing lows. So you can see that the Fibonacci trend line cuts through the price structure. So this is something you want to avoid, especially when you are drawing your harmonics shapes. You want to make sure you follow price structure very closely. Okay, we saw this earlier. Okay, so let's get into our brief intro to harmonics. So harmonic patterns are pretty popular trading strategy since it involves technical analysis and it identifies potential price reversal points in financial markets. So these patterns are based on Fibonacci retracement and extension levels, which is why we went through them before going through some of these patterns. And these are basically mathematical ratios that traders believe are significant in determining potential support and resistance levels. So harmonic patterns foundation was laid by H.M. Gartley in 1932 and later developed further by many authors like Scott Carney in his book of harmonic trading. So harmonic patterns basically reflect geometric price structures. So for example, retracements, projections, and swings. These adhere to Fibonacci ratio relationships. In other words, retracement, the projection price swings that form these patterns and are interlinked together based on specified Fibonacci ratios. So the ratios that we normally use for harmonic patterns are those I mentioned earlier, 61, 78, and the levels that are more than 100, so 127 and 161. So these harmonic structures exhibit unique price structures or movements and key turning or trend reversal points. This factor is very helpful in trading as it provides highly trustful price entries and key levels for targets or stops. Unlike other trading methods, harmonic trading attempts to predict future movements, and this is what differentiates it from other indicators or oscillators, which tend to be lagging, and in terms of how they work as well. Okay, let's briefly talk about some basic pattern identification. So some of these patterns can be quite complex and a bit technical to understand, but once you understand the pattern structure, they can be spotted quite easily. So these patterns are either forming or completed M or W shapes. or they could be combinations of M or W as well. So all primary harmonic patterns are 5-point patterns with points X, A, B, C, and D. And price swings between these points are interrelated and have harmonic ratios based on Fibonacci. Okay, so Fibonacci ratios are really helpful in trying to understand and defining precise turning points in these patterns. Okay, so starting off with the W bottom, you can see where exactly we're expecting price to break out of, where you should place your targets. For an M as well, it's just the opposite. So there are many variations of the W or the M patterns. And yeah, this is what we're talking about, the A, B, C, D, E shapes. Or it could be labeled as X, A, B, C, D as well. The main thing is that there are 5 points that are labeled on your patterns. Okay, so here's a 5-point pattern example. So all 5-point harmonic patterns have similar principles and structures, and they differ only by the ratios that are used to identify them and locate their keynotes X, A, B, C, and D. So 5-point harmonic patterns have a critical origin X followed by an impulse wave XA. That's followed by a corrective wave to form the I of the pattern at B, completing the AB leg. So basically this purple level there. And then it's followed by a trend wave, BC, and finally completed by a corrective leg, CD, that ends around the potential reversal zone. So if you look at this diagram, the levels, these like 0.38 to 0.618, these are your Fibonacci levels that we're using. So if I were to place a Fibonacci trend line here, one here and the ending point here, you can see that price has retraced 61.8% of your original line. So that's basically just what the levels mean. Okay. So here you can see projection at 161.8, retracement at 88.6, projection 261.8. So a possible pattern formation is identified after the first 3 legs, XA, AB, and BC are completed. So you're projecting your reversal to happen from somewhere here. Okay, so your entry level should start about past this area here. So potential trade setup is recognized as the last leg CD starts to develop. Fibonacci ratio extensions, retracements, and projections are then used to determine your potential reversal zone or your PRZ, which you can see here. This is basically your, if you've been with us, the Fibonacci confluence area, this could be one of your area as well, because you're basically projecting prices to reverse off of that area. So hit down, be attracted to the area, and then bounce off. So it's kind of that same concept. So all harmonic patterns have a clearly predefined PRZ. The initiation of new trades should take place in this zone and only after price reversal pattern action. Okay, so let's start with the first pattern, which is the Gartley pattern. So it was first outlined by H.M. Gartley, and the Gartley pattern is probably the best known harmonic pattern. Structure and appearance wise, the Gartley pattern typically forms in a trending market, and it has an M shape in a downtrend or a W shape in an uptrend. Okay, so remember, because these are kind of reversal patterns, so that's why we're calling this a bullish Gartley, because it should be in a downtrend, and then we're looking for a reversal into an uptrend. Bearish because it's an uptrend and we're looking at a reversal into a downtrend. So how it works, or the rules for a harmonic pattern, the AB leg should retrace about 61.8% of leg XA, BC should retrace 38.2% to 88.6% of XA, and CD is at least a 78.6% retracement of leg XA. Okay, so long positions should be considered after a clear bullish reversal with a stop loss that's placed below here. So you can see the PRZ happens around point D. So we're going in for a buy here, and you place your stop loss below your buy level. So target 1 for this pattern is at your 38.2% retracement of your AD. So if you draw a Fibonacci retracement here, as long as it's 38.2% above 38.2, you can place your target profit there. While target 2 extends towards the 61.8% of AD. So if price breaks out of the 30.2% retracement, then you can go in continuously for a buy towards your 61.8. So the bearish Gartley, of course, is just the opposite of that. If you're using a bearish Gartley, your short positions should be considered after that clear bearish reversal. So off of this D, with a stop loss placed above the D level. Okay, again, target for this pattern is 38.2% retracement AD, while target 2, 61.8% retracement of AD as well. Okay, so the concept behind Gartley pattern is based on the idea that after a significant price move, so this huge shoot upwards, the market will retrace AB followed by another move in the original direction before completing the pattern with a final leg, which is your CD. And this ends at a Fibonacci retracement of your initial A move. Okay, so once you understand it, it's pretty straightforward. Okay, now let's look at the next pattern, which is your bat pattern. So the bat pattern is typically considered to be the most accurate pattern. In terms of structure and appearance, it's pretty similar to your Gartley, but has a different Fibonacci ratio. Also has an M shape in a downtrend or a W shape in an uptrend. Okay, so the main rules of the bat are AB can retrace between 38.2 to 50% of XA. BC can retrace between 38.2 to 88.6 of AB. And CD can retrace up to 88.6% of XA. CD leg can also be an extension of between 161.8 to 261.8 of AB leg. Okay, so your completion D typically will lie about 88.6% retracement of your XA leg, like we see here. Okay, so for long positions, you can consider them if we're looking at bullish bet, long positions would be after that D level. So you place your stop loss here. Your potential reversal zone will be this purple highlighted point, and prices are headed upwards, so you can place your take profit. Again, 38.2 retracement of this level, AD, or 61.8 as well. Stop loss will just be placed below here. Similarly for a bearish bet, prices heading downwards, your stop loss will be up here, somewhere here, and you're heading towards 38.2 or 61.8 retracement of your initial leg, which is your XA. Okay, so the difference between bat pattern and Gartley is that the that pattern emphasizes a deeper retracement in this AB and also a shorter extension in the CD leg compared to Gartley. So it's also considered to be more reliable than Gartley due to this deeper B retracement, which also allows for better risk to reward ratio. Okay, any questions so far? Okay, if not, let's move on to the next pattern, which is the cipher pattern. So for cipher, again, it's formed by 4 price swings that's labeled as X, A, B, C, and D. This is more complex compared to the other harmonic patterns. And yeah, it also uses different Fibonacci ratios. So the Fibonacci relationship here, XA leg, which is the initial price movement, can be either direction. So here it's up, bearish would be downwards. So your AB leg after that should be between 38.2 to 61.8 of the original XA. Your BC leg is a sharp extension of AB, typically extending to 127.2 or 141.4 of the AB leg. So here you can see we are employing that Fibonacci extension technique that we used earlier. BC leg is, we talked about that already. Your CD leg retraces from your BC leg, ending at a level between 78.6 and 100 of your XC leg. So for this level, you will connect your X to your C level in order to determine whether your D is part of the cipher pattern. Okay, so this is pretty distinctive from the final leg of other harmonic patterns, such as your butterfly or your Gartley. Yes, an entry is after the pattern. Endpoints of the legs are wicks or body of candles. We normally will include the wicks as well because we are using Fibonacci levels. Yeah, so even if we're not looking at harmonics, just Fibonacci, we take into account the wick as well. But yes, entry is after the pattern. So once this pattern is completed and we start to see that reversal, then we will go in for the buy. For bullish, for bearish, here you can see, that's why we call it bearish, because once price is moved up, once it reverses, we're going for a sell here. Okay, so the concept behind this pattern is based on the idea that after a specific series of price movements, and you can see it's very specific in terms of the retracement levels, the market is likely to reverse direction. So it differs from other harmonic patterns in that the BC leg, so this one here, extends beyond the starting point of your XA leg. So it creates a deep retracement for your CD. Okay, so again, this pattern is considered one of the most accurate harmonic patterns with a high probability of predicting your reversals. Okay, so again, target levels you can stick to typically 38.2 to 61.8 of your CD leg here. So you place your target somewhere 61 or 38. Stop loss will be placed slightly beyond this X to protect against a false breakout. Okay, any questions? Okay, here's an example of your cipher pattern on an actual chart. So you can see, yeah. So I think if you look at it at one glance, you can't really see what's going on. So you do have to go in and use your Fibonacci retracement tool to label all of the levels, the 78.1 that we mentioned, the 127, yeah. But yes, so you can see once price reverses off of that D level, then we'll go in for a buy. These patterns can work on any chart. You can see in this example, we're looking at Euro Yen on the 1 day time frame. So I'm sure you could find it on gold as well. Although now on gold, prices are kind of moving in an uptrend, whereas these harmonic patterns tend to work better in trending markets. So, but still you might be able to find it on gold as well. So yeah, it works on any kind of chart. Okay, let's move on. So next, we're going to look at the butterfly pattern. So butterfly pattern also uses the M or W shape, but it's different from Gartley and Bett in that it extends beyond the starting point of your pattern, which is your point X. So the Fibonacci relationship, again, we're looking at AB retracing 78.6% of your initial price movement, so XA. And then for your, I talked about AB, yeah. So next is BC, and you will be looking at a 78.6% retracement, 30.2 to 88.6 retracement on your XA, and your CD would just be a 1.61. Actually, these are levels greater than 100. So it'd be 161.8 to your 261.8 level. So again, here you are seeing that same Fibonacci extension level. Okay, so yeah, that's why we went through your Nike tick shape, because you can see very clearly how it would work on some patterns as well. Okay, and lastly, of course, your CD is a 127 to 161.8 retracement of your XA. Okay, so concept behind this is that it basically indicates a potential market reversal beyond this starting point. So that's the difference between Gartley and Bett. It's also a more aggressive pattern, so it predicts a stronger reversal. So it's based on the idea that the market often will overextend beyond the initial impulse move, which is your XA, before it starts to reverse. Okay, we have a question. Are the patterns best seen on daily charts? It kind of depends on your trading style. We normally will use this on either daily or for 1 hour or 4 hour time frames. So we normally won't go anything below 15 minute. I think 30-minute works as well. But anything below 15 minute tends to get a little bit harder to analyze because charts are noisier. Yeah. So normally 30-minute, 1 hour, 4 hours, or daily works as well. Okay, but generally, your harmonic patterns increase in reliability with higher time frames because they are less influenced by, your short-term fluctuations and market noise. So that's why we normally use 4 hours or daily. Okay. Lastly, or not lastly, but we are going to look at the crab pattern. So crab pattern was actually released in 2001, and this is a pretty extreme pattern as well because the corrective wave, your AB, should end between 38.2 and 61.8. Okay, so for the Fibonacci levels, you're basically looking at XA as the initial price movement again. AB is the retracement of 38.2, 61.8, as I mentioned. BC is 38.2 to 88.6 of your AB. CD is just the defining feature of your crab pattern, which is an extreme extension of the XA leg. You can see it's 161.8. It can actually go even higher. So if you look at your BC extension, here if you're using the Nike tick method that we used earlier, you'll be looking at somewhere between 224 to 361. So this is the defining feature of your crab pattern. Okay, so this pattern was discovered by Scott Carney, and it's considered one of the most accurate harmonic patterns as well, simply because of this deep extension of the final leg. Okay, so yeah, this is one of I think it's the largest extension, especially for the last leg here. Okay, next let's look at the shark pattern. So this pattern is relatively new, also introduced by Scott Carney. This pattern is unique because it doesn't follow that traditional XAB CD structure that we've seen in the other harmonic patterns. Instead, it uses a 5-point structure that's labeled OXABC. So it's known for its sharp price patterns or price movements and the ability to identify potential reversal zones before the final point of traditional patterns. So structure and appearance-wise, it's characterized by this steep OX initial move, followed by a sharp retracement of your XA, deep extension, again your AB, and another retracement BC, and is considered a continuation or a reversal pattern depending on where it forms in the trend. So in this example, we are using it as a reversal. That's why you can see price after the completion of the shape. We are projecting it to reverse. But if you found it somewhere between the BC line, of course, you'd be expecting a continuation. Okay, so the strength of sharp pattern is that it is able to identify potential reversals earlier than the other patterns, such as your crab and your bat, because you're looking at you're looking at this price pattern before its completion. So you don't have to wait for your C level to form before going in for your trade. Reason being, your BC level is so long, so if it doesn't fall within this 113, you can just assume that prices are going to continue. Once it hits or it falls anywhere between 113 and 161.8, projection of your AB, then you can go in for a buy. or sell if you're looking at the bearish sharp pattern. Okay, so the target profits, where you should place your target profit and stop loss, for all of these patterns lies about 38.2 to your 61.8 retracement of your this final line here. And then your stop loss would just be outside of that initial line. Okay, now let's look at the advantages and disadvantages of harmonic patterns. So harmonic patterns provide future price projections and stop levels in advance and are considered leading indicators. They're frequent, repeatable, reliable, and produce high probable setups. And the trading rules are relatively standard since they're using Fibonacci ratios. And they work on all time frames and on all market instruments. Other momentum indicators like your CCI, RSI, MACD, DMARC, and so on can be used along with them as well. Some disadvantages: harmonic patterns are complex and highly technical to understand. Correct identification and observation or coding of harmonic patterns is difficult. Conflicting Fibonacci retracement and or projections make it difficult to identify the reversal or projection zones, and complexity arises when we get opposing patterns from different time frames. So the risk reward factors from some of the patterns are also pretty low. And yeah, that's all I have for you guys for today. Let me know if you guys have any other questions. But if not, thank you guys so much for joining me. I hope you guys found this session helpful and have a great rest of your week. And if you guys like me, feel free to connect with me on LinkedIn. It's just my name, Melanie Chong. And yeah, I'll see you guys again next week. Thanks, everyone. Bye.